Is the U.S. housing market heading toward another meltdown like 2008? For many Americans, it feels eerily familiar. Skyrocketing home prices, rising interest rates, shaky job markets, and a growing number of investors dominating the market. While no two crises are exactly the same, the warning signs flashing today are hard to ignore. Higher interest rates, a crushing burden. Mortgage rates are now above 7%. The highest sustained levels in over 2 decades. And unlike during the early 2010s, rates aren't likely to come down anytime soon. Inflation remains sticky, forcing the Federal Reserve to keep monetary policy tight. For buyers, that means monthly payments have exploded, pricing out millions of potential homeowners. A $400,000 mortgage today costs hundreds more per month than it did just a few years ago. For families on the edge, that difference is the tipping point between owning and staying stuck in the rental market. Home prices more expensive than in 2008. Even with rates rising, prices haven't meaningfully dropped. By some key metrics, like the price-to-income ratio and the cost of monthly payments compared to household earnings, homes are actually less affordable today than they were in 2008. That's an incredible statement, given that 2008 was the peak of the infamous housing bubble. Today's combination of elevated prices and high borrowing costs creates the worst affordability crisis in modern history. The investor factor, fuel on the fire. Back in 2008, the average homebuyer was a family looking for shelter. In 2025, the story looks different. Investors, from small flippers to giant Wall Street-backed firms, own a growing share of the housing stock. In hot markets like Phoenix, Atlanta, and Dallas, investors accounted for more than 25% of purchases in recent years. While investor demand helped prop up prices, it also created fragility. If rental returns shrink or financing tightens, investors could dump properties en masse, flooding the market with supply. That's the kind of cascade that can turn a slowdown into a crash. Job markets are softening. Housing doesn't exist in a vacuum. It's tied directly to the strength of employment and income. While unemployment rates remain relatively low compared to historic averages, cracks are appearing. Layoffs in tech, finance, and even retail suggest a cooling labor market. Youth unemployment is already at crisis levels, and if job losses spread, homeowners may struggle to keep up with inflated mortgage payments. Rising delinquencies could follow, a story that echoes 2007, when defaults started climbing long before the broader crash hit. Key differences from 2008. Of course, today is not a carbon copy of the subprime crisis. Banks aren't handing out reckless, no-doc loans, and most homeowners hold fixed-rate mortgages locked in at much lower levels. This limits the risk of a sudden wave of forced selling. Housing supply is also much tighter than it was 15 years ago, as years of underbuilding created a structural shortage. These differences may prevent a complete collapse, but they won't shield vulnerable buyers and stretched households from pain. What happens next? The path forward will depend on a few critical factors. If inflation remains sticky and the Fed holds rates high, affordability will only worsen. If unemployment rises sharply, forced selling could create pressure on prices. And if investors start running for the exits, the market could spiral quickly. For ordinary Americans, the message is clear. This is not the time to gamble on speculative real estate bets. Buyers should focus on affordability and stability, not chasing rising values. Homeowners should secure their financing and avoid risky refinancing that increases exposure. Renters may find opportunities in the next 12 to 24 months if prices soften, but patience is key. Conclusion. Is this truly 2008 all over again? The details differ, but the rhyme is unmistakable. Elevated prices, crushing interest rates, investor speculation, and a weakening job market form a dangerous cocktail. Even if we don't see a catastrophic collapse, the risks of a painful correction are real. For anyone watching the housing market today, the warning is clear: proceed with caution. Don't forget to like, comment, and subscribe to our channel for more breaking news.